So you want to own a bank. And before we go anywhere near what one costs, you need to see how one actually works. Every surprising thing in this video comes out of the same simple circuit, so it is worth 2 minutes to draw it properly. It starts with money coming in, and it comes in from 3 different places. The first is the one everybody pictures. Depositors. People and businesses walk in or open an app and hand you their money for safekeeping. That is the cheapest money you will ever get, and we will come back to why. The second is the wholesale market. You borrow from other banks and from investors bigger amounts for fixed periods at a higher price than your depositors charge you. And the third is the one that sets the price of the other two. You can borrow from the central bank itself. In America, the Federal Reserve. It is the lender that is always open, and it sets the price of everything else in this building. That last part is the piece to hold on to. The central bank does not just lend to you. It sets the base rate, the floor price of money in the entire country, and every other number in your bank is priced off it. Now the money goes out. You lend it. Mortgages, car loans, business loans, credit cards. And you buy safe assets with a chunk of it, government bonds, mostly because they pay a little and they're supposed to be the thing that never surprises you. And that is the whole circuit. Money comes in from depositors, from the market, and from the central bank. It goes out as loans and bonds. What comes back is more than what went out. Say the base rate is 3. You pay your depositors close to nothing and your wholesale lenders a bit above 3. You lend at 6 or 7. The gap between what you pay for money and what you charge for money is the spread. And that is the belief. Borrow low, lend high, keep the difference forever on money that was never yours in the first place. It is the oldest and cleanest idea in business. No inventory to spoil, no season to survive, no weather to worry about. You are renting out money, and money never goes out of fashion. That is not what a bank is. That is what a bank looks like from the outside of the counter. Because here is the number that ends that version of the story. Across every insured bank in America, all 4,336 of them, the entire industry earned a return on assets last year of 1.2%. 1.2% on everything they own. That is not a wide spread, quietly compounding. That is a margin thinner than almost any business we have ever taken apart on this channel. And the spread itself, the gap we just drew, the whole point of the circuit, 3.39%, 3 cents on the dollar. And that was the highest it had been since 2019, a 6-year high. So the belief is not slightly wrong. It is pointed in the wrong direction entirely. A bank is not a business that makes a lot of money on your deposits. It is a business that makes almost nothing on them. And yet the industry cleared $295.6 billion in profit last year, up more than 10%. Both of those things are true at the same time, which leaves exactly one question, and the whole video is the answer to it. How do you turn 1.2% into $295 billion? You do not do it by earning more. You do it by owning almost none of what you are earning it on. $25.1 trillion of assets sit on the balance sheets of American banks. The equity underneath them, the part that actually belongs to the owners, is $2.6 trillion. Everything else is somebody else's. Look back at the circuit, the depositors, the market, the central bank. It is, in the most literal sense, your money doing the work. By the end of this, you will understand why the safest sounding business in the world is built entirely on a promise it could not keep if everyone asked at once, and why that is not a flaw in the design. It is the design. Let's start with the price of admission. Every other business in this series has a price. You can look it up. You can put a number on the building, the fit out, the equipment, and know what it costs to begin. A bank does not have a price. A bank has a permission. You cannot buy one the way you buy a building. You have to be allowed to have one by people whose entire job is deciding whether you should. On paper, the number is almost disappointing. The minimum capital and surplus for a new national bank is $6 million. $6 million for a business that will handle other people's life savings. That is less than a mid-sized apartment block in most American cities. But that is the floor written in the rule book, and nobody has opened a bank at the floor in a very long time. In practice, industry figures put the realistic figure at around $20 million just to raise the starting capital, and a recent group of 5 community bank charters came in between $27 and $50 million. And if you want to do it in the New York metro area, most estimates start at $50 million and go up from there. And at the far end, one industrial bank charter is reported to have been approved only on condition of $280 million of paid-in capital before it was allowed to take a single deposit. So the real entry price is somewhere between $6 million and $280 million, and which one applies to you is not decided by the market. It is decided by a regulator reading your business plan. That is the first thing that makes this asset different from every other one we have looked at. There is no listing. There is no asking price. There is an application, and the application takes time. Getting a new bank approved runs well beyond a year before the doors open. And once they do open, you are supervised more closely than an established bank for 3 full years. During those 3 years, you are required to hold a Tier 1 leverage ratio of at least 8%. In plain language, for the first 3 years, the regulator sets a hard limit on how much of other people's money you are allowed to use. Hold on to that sentence, because we're going to come back to it. The thing they cap in the years when you're most likely to fail is the exact thing that makes a bank profitable. And once you are through, what have you actually bought? Not a building. Most banks lease their branches like everybody else. You have bought a position, the right to stand in the place where other people's money moves and to be paid for standing there. There are 4,336 of those positions in America. 3,815 commercial banks, 521 savings institutions. And that number is falling. Not long ago, it was 5,177. Around 840 of those positions have simply disappeared, roughly 1 in 6 gone. Nobody is opening banks. In the entire fourth quarter of last year, across the whole United States, exactly 1 bank opened. So you have your permission. The doors are open. Now let's talk about what it costs you to keep them open. And the first thing to understand is that a deposit is not income. A deposit is a debt. When somebody puts $10,000 into your bank, you have not received $10,000. You have borrowed $10,000 from someone who can ask for all of it back tomorrow morning without telling you first. It sits on your balance sheet as a liability, alongside every other loan you have ever taken, because that is what it is. Here's the thing nobody tells you about this business. Your customers are your creditors. Every single one of them. The queue at the counter is a queue of people you owe money to, and they charge you for it. Last year, American banks paid out $504 billion in interest to depositors and lenders for the use of money the bank does not own. Against that, they took in $1.24 trillion in interest income. Everything they lent, everything they invested, all of it, which leaves $738 billion of net interest income. That is the spread. That is the famous, obvious, everyone knows this part of banking, and it is a real number. Now watch what happens to it. Running the branches, paying the staff, the compliance departments, the auditors, the core banking systems, the insurance, the buildings, the industry's operating costs last year came to $604.7 billion. Set those two side by side. $738 billion earned on the spread. $604 billion spent keeping the lights on. The cost of running the bank eats 82% of the spread the bank exists to earn. And these costs do not move. A branch costs the same on a Tuesday when nobody comes in. Compliance costs the same in a year when nothing goes wrong. The deposit insurance premium is due whether you lent well or badly. This is the same flat line we have found in every business on this channel, and it does exactly what it always does. It sits there, indifferent to how the year is going. Then take off $93 billion for loans that go bad. Money set aside for borrowers who will not pay you back, which is a permanent, structural cost of lending to human beings. And what is left, after all of it, is that 1.2%. So the spread is real. It is just not yours. Most of it goes straight back out of the door to keep the machine that generates it running. Which raises an obvious question. If the lending barely covers the building, where does $295 billion of profit actually come from? Look at the sign in the window of any bank branch in America, and you will see the same word. Free. Free checking. No monthly fee. No minimum balance. Open an account in 10 minutes, and we will give you the account, the card, the app, the branch, the ATM network, and the customer service, and charge you nothing for any of it. Which should strike you as strange, because you have just spent 3 minutes learning that running that infrastructure costs $600 billion a year. Nobody gives away a $600 billion service. The account is not the product. The account is the bait. Here is what actually buys them. A checking account is the cheapest money a bank will ever get. Deposits in a current account pay almost no interest, and they sit there for years. Every free account you open hands the bank a small, permanent, nearly free loan. Multiply that by 100 million Americans, and you have the cheapest funding source in the entire financial system. But here's where it gets interesting. The free account is not just cheap funding. It is also, quietly, a revenue line of its own. Last year, American banks and credit unions took $12 billion in overdraft and insufficient funds fees from accounts advertised as free. The 20 largest consumer banks accounted for about $4 billion of it. One bank alone took roughly $1.1 billion in overdraft fees in a single year. Another took $924 million. And this is not a shrinking business. Overdraft revenue at the top 20 banks is up over 6% compared to 2 years earlier. There was very nearly an end to it. Regulators finalized a rule capping overdraft fees at $5, due to take effect in October of last year. Congress reversed it. Now step back and look at the whole revenue picture, because this is where the belief we started with really falls apart. Net interest income, the spread, the lending, the thing everyone thinks banking is $738 billion. Everything else, fees, cards, account charges, overdrafts, trading, wealth management, the lot, $338 billion. Which means roughly a third of the American banking industry's revenue has nothing whatsoever to do with lending your deposits at a higher rate. A third of the business is just charging you for having the account. So we have a business with a 3-cent margin, costs that eat most of it, and a third of its revenue coming from fees. Read that again, because none of it explains $295 billion of profit. And it does not explain it, because we have been looking at the wrong number the whole time. We have been asking how much a bank earns. The question is how much it earns it on. $25.1 trillion of assets. $2.6 trillion of equity. The banking industry's leverage ratio is 9.33%. Turn that around, and it means for every dollar of their own money that bank owners have put in, they're holding roughly $11 of assets. And that is the entire business. That is the answer to the question we asked at the start. 1.2% is a terrible return. 1.2%, earn 11 times over on money you borrowed at almost nothing, is an excellent one. A bank does not make money by being profitable. A bank makes money by being profitable repeatedly, on the same small sliver of its own capital, using a very large amount of everybody else's. Now compare that to the last business we broke down where the house had an edge. A casino's advantage on a roulette wheel is small, a couple of percent, depending on the table. And a casino makes an enormous amount of money from it, because the wheel spins thousands of times a night. A bank runs a thinner edge than that. And it makes more, because it is not spinning its own chips. It is spinning yours. But leverage is a mirror. It does not know which direction you are facing. If $11 of assets earn you 1.2%, your own dollar earns beautifully. And if those same $11 fall in value by 9%, not a collapse, not a catastrophe, 9%, the dollar's gone. All of it. The equity is wiped out and the bank is insolvent. Every business on this channel has had a version of this. Leverage is why a leveraged buyout can kill a football club that is still selling out its stadium. But no other asset we have looked at runs at 11 to 1 as its normal, healthy, regulator-approved operating condition. And there is a second problem, and it is worse than the first. Look at what a bank owns, and look at what a bank owes. What it owns is long. 30-year mortgages, 10-year bonds, business loans running for years. Money that is promised to come back slowly, on a schedule, over decades. What it owes is short. Deposits, repayable in full, on demand, immediately, to anyone who asks, with no notice whatsoever. A bank is a business that borrows money for one day and lends it for 30 years, and the entire thing works only because the people it borrowed from do not all turn up on the same day. That is not a risk a bank manages. That is what a bank is. Remove it and there is no bank, just a very expensive safety deposit box. And the money most likely to move is the money that is not protected. Uninsured deposits, the balances above the government guarantee, rose by $214.7 billion in a single quarter last year. That money belongs to people and businesses who are paying attention. It is the first money out of the door, and it leaves at the speed of a phone. Now, this is the part of the video where for 6 videos running, we have counted the queue and found you at the back of it. The landlord gets paid on the lease. The supplier gets paid on delivery. The franchisor gets paid on revenue, not profit. And the owner, the person who signed for all of it, eats last. A bank breaks that pattern, and it is the only asset we have found that does. Because a bank does not stand in the queue. A bank is the queue. Every business we have taken apart pays its people through a bank, collects from its customers through a bank, holds its float in a bank, borrows its fit-out money from a bank. The gym owner waiting 15 years to see his own money back is making his loan repayments to somebody. That somebody is the position we are describing right now. When the money moves, it moves through here, and the account it moves through belongs to you. Think about that for a second, because it reframes everything we have said on this channel. For 6 videos, we have been describing the same pyramid from underneath. This is what it looks like from the top of it. But, and this is the part the fantasy always leaves out, being first in the queue in the good years does not make you first in the queue when it ends. If the bank fails, the order reverses completely, and it reverses against you. Depositors are creditors, and they rank ahead of you. The insurance fund that covers them ranks ahead of you. Bondholders rank ahead of you. Equity, your money, is last. That fund is real, and it is large. The deposit insurance fund held $153.9 billion at the end of last year. So you're first in line every single day the bank is open, and dead last on the one day it is not. Now, the freehold question, because we ask it of every asset. With most businesses, you can buy the building and stop paying rent to somebody else. What is the equivalent here? There isn't one, and that is the point. You cannot buy your way further up this queue because you're already at the top of it. The charter is the freehold. The permission is the asset, which is exactly why it is rationed, why it takes a year to get, and why one bank opened in America last quarter. And it explains the shape of the industry. Community banks, the small, local, independent ones, make up 90% of all insured institutions in America. 90% of the banks. And they earn $29.9 billion of the industry's $295 billion in profit. About 10%. Now here is the strange part. The small banks are not worse at banking. Their net interest margin last year was 3.65% against the industry's 3.39%. The small banks earn a wider spread than the giants and take 1/10 of the profit. Because the spread was never the business. Scale is the business, and they do not have it. They cannot spread compliance costs across 10,000 branches. They cannot fund themselves as cheaply. They cannot lever as far or as safely. So they earn more per dollar and end up with less. It is the same squeeze that kills every independent competing with a national chain, and it is why 840 of those positions have vanished. For most of banking history, the thing we described in Chapter 5 never happened. Everybody knew a bank run was possible. Nobody had watched a large, modern, well-capitalized American bank die of one. Then came March of 2023. On the 10th of March, Silicon Valley Bank failed. It had not made reckless loans. It had bought government bonds, the safest asset there is, and then interest rates rose, and bonds that were worth 100 were suddenly worth less. That was survivable as long as it never had to sell them. The losses were on paper. The bonds would eventually mature. But the depositors were technology companies with balances far above the insured limit. They talked to each other. And when the word spread that the bank might need to sell those bonds at a loss, they moved, not over weeks, but over hours on their phones all at once. Silicon Valley Bank became the 3rd largest bank failure in American history in the space of about 2 days. That's worth sitting with. Not because it had lost the money, because everybody asked for it at the same time. 2 days later, Signature Bank went with $110.4 billion in assets. 7 weeks after that, on the 1st of May, First Republic, $229.1 billion, became the 2nd largest bank failure the United States has ever recorded. 3 of the 4 biggest bank failures in American history inside 8 weeks. Together, about $548 billion of assets, which made 2023 the largest single year of bank failures ever, bigger than 1984, bigger than 2008. And none of them failed because the lending was bad. They failed because the funding was short and the assets were long, and somebody noticed. It is calm again now. 60 banks sit on the regulator's problem list. 1.4% of all banks, which is squarely inside what the FDIC calls the normal range for non-crisis periods. Not one bank failed in the final quarter of last year. But 5.1% of American banks did not make a profit at all last year. 1 in 20. In a good year, with the highest spread since 2019. So, should you own a bank? In a good year, it is close to the finest business ever constructed. 1.2% on assets, run 11 times over, on money that costs you almost nothing and arrive by itself, from customers who thank you for holding it and pay you a fee for the privilege. In a bad year, the identical structure runs backwards. A 9% fall in what you own erases everything you have. And it does not matter how carefully you lent, because the people who can end you are not your borrowers. They are your customers, and they can leave on a Tuesday afternoon without warning. So look at what a bank actually is, laid end to end. A permission you cannot simply buy, granted by a regulator instead of a market. A spread of 3 cents on the dollar. A return of 1.2%, which by itself would be a bad business. Run 11 times over on money that is not yours. And every dollar of it repayable on demand, without notice, on any afternoon, for any reason. Every other owner we have followed on this channel stood in the queue and waited to be paid. This one is the queue. Right up until the morning, everybody wants their money back and discovers they are standing in it too. So, would you actually own one? Yes or not a chance? One word in the comments. And if there's a business you want put under the microscope next, drop that too. Thanks for watching. And the next time you check your balance and see your money sitting there, remember that it is not sitting anywhere. It is out working for someone who is paying you 3% and thanking you for the loan. Subscribe, and we'll take another business apart next time.